All right, good afternoon. For those of you that do not know, September is Life Insurance Awareness Month. And, Caitlin, I give credit where credit's due. So I'm a financial advisor over 30 years in the business, and I offer clients, we discuss, talk, analyze, review life insurance on a regular basis across the spectrum. And this call is not designed to be a education on life insurance per se. Really, when I thought about it, I said, there are so many aspects to life insurance that are quite often commoditized that take away some of the true power that Congress has given the American taxpayer. But really what I wanted to do is just have a high level discussion with everybody so that they can, when they're thinking about your life insurance, you really should get into the habit. If nothing else, put it on your calendar for September to be your beneficiary review month, right? So when you hear life insurance, I want you to go find your contracts that you purchase, 5, 10, 15, 20, 30 years ago, put them into a drawer and haven't looked at, and double check your beneficiaries. And that should go across all your financial accounts, right? Anything that has a beneficiary designated, you should review. But life insurance is afforded a luxury that it can pass outside of an estate and doesn't have to go through probate. And I just got a call from somebody that I'm helping sort out an issue where, somebody had left somebody some money. And, after 3 years of probate, and now the executor doesn't want to pay the beneficiary or the named person in the will and trust, and so now you got litigation involved. And a lot of this stuff can be avoided by just properly naming your beneficiaries, because those pass directly. And not only do they pass income tax free, typically, right? So what is human life value, or why is it important? Well, to determine the value of a human life, how do you do that, right? And I put this picture here because when I found it, I said there's so many elements of needs. There's people that think that small children, God forbid something happens, there's an absolute cost to go to the funeral and to bury somebody. But maybe as we get younger and we're raising a family or something happens unexpected, we hear this day in and day out. And then, as when I first came into the business and before I had learned anything, I was sold on the bill of goods, buy term and invest the difference. And what I found out from that years and years of study, how wrong I had been led. And so in advising my clients, what I find first is lead with education, help people understand why it's powerful and what it can do for them. And then you can put very, very powerful leverage in place. So human life value is a concept used by financial planners, insurance professionals, and individuals alike to assess the economic worth of an individual. While it may seem difficult to assign a monetary value to something as let's just close this, move this up, intangible as a person's life, calculating HLV can provide valuable insights for financial planning, risk management, insurance needs. Okay, so that's why it's important. That's the lingo. As we move on, the initial step in determining human life value is evaluating the person's present income and capacity to earn in the future. And this is a hard thing. In my experience and through my life, one of the things that I started to become aware of, when I'm speaking to a couple or I'm speaking to somebody, human nature ingrained, we have a very difficult time envisioning our own personal demise. We're just typically not wired that way. So when I think about my death, my just an untimely death, an accident, right? They're unpleasant thoughts, one. And B, typically human beings are not designed to think about, hey, it could happen, but it's not going to happen to me. And I mean, that goes across the gambit, where sometimes we tend to align ourselves or figure out a little bit more correctly is it's if we're married, a spouse, or a breadwinner. right? If something happened to them, how would we be affected? So that we can relate to. So quite often when I'm sharing with folks this concept, I want to make sure that we understand that, hey, listen, I have to kill off one of us. And typically I'll pick the male because, statistically, women do outlive men. And if, in today's world, we're typically both income earners in a household, especially if you're living in New Jersey, we're both contributing towards, the success of the family. But in our early years, and if you're raising a family and you have children, right, something happens, right? And that is if the female is staying at home, at least immediately, and raising for children, right? What happens if she passes unexpectedly? So now when I'm speaking to the other breadwinner and I say, hey, you were going off to work, you have 2 children that are now uncared for. You now have to think about this in the form of, either you stop working to care for them or we have to replace those functions, right? So this assessment takes into account various factors like age, education, skills, and professional trajectory. It's a very complex arena. It's not uncommon for the human value life approach to be written off as overkill. And I'll be honest with you, when I first saw some of the numbers, when you look at the math, if something were to happen, and I will look at an example here shortly, it blows my mind, right? How much money, how large of a sum of money today to replace somebody if they were to leave us, like I said, unexpectedly. So clients either believe that buying insurance up to their full human life value is simply too much money for their heirs, or the numbers don't seem real. And again, like I said, my own personal experience, I went through this. So that's why I'm not trying to sell insurance. What we're trying to do is solve a problem. And sometimes it's problems that we have a hard time as human beings getting our heads around. So this approach, however, is actually incredibly important for you, right? So consider, would you buy a $50,000 car, yet only insure it for $30,000 because that's all you needed, right? And no, you wouldn't dream of doing so because you'd be shortchanging yourself. And yet this happens every day in the life insurance industry all the time by way of needs analysis. Somebody just is trying to get in here, Thomas. Hold on. Good. All right. And so the problem with the needs analysis is that it's ultimately futile to try and determine how much life insurance is necessary. There are too many extraneous factors like inflation, taxes, potential future earnings, and exactly how much you need to replace. And this is why, it's the commoditization that is on the radio, TV, these insurance companies that just term, buy it, I'm Big Lou and or SBLI or whatever it is, right? Any of this stuff, I don't begrudge them soliciting, but when they turn around and say, you can get, $1 million a term for $20 a month. I mean, it is so misleading because there are so many factors involved. And how do you know? Right. I'm working with a company right now on a buy-sell agreement for the plumbers and the 2 young sons and the brothers. And we have a multitude of factors, right? We have the cross-purchase arrangement. We have, now they're going to be in business with their spouses. How do we determine all this stuff? And then how do they do and save for themselves individually? So, I really do press back when I hear this commoditization, because again, if you want cheap term insurance, we offer that. We can do that. We have a complete, that is absolutely one of the things we do. We can offer something if it fills a need. But to go into it with the approach of that the industry and the financial, this is Dave Ramsey or Susie Orman, right? A lot of them will say, all you need to do is just buy enough for the mortgage. You don't need life insurance. Put your money in mutual funds. That was the same school I went to 30 plus years ago, right? And how incredibly wrong, or like I said, misleading. I'm not saying there's not a section of the population where that may be true, But because it is such a great strategy to implement and use leverage, to use math, to use the tax code for the American payers' benefit, it really should be reviewed with a professional. So how much life insurance coverage should you have? Well, I can tell you this. People are not opposed to owning life insurance, right? And how do I know this? Because I've asked them, right? What is the number one objection, the issue, the challenge we as human beings face when we're looking at life insurance? It's the cost. Because if it was free, we would buy as much as we possibly could get. And the example I used to use, or the analogy, if I was a life insurance salesman on a plane writing guaranteed issue, instant issue on a plane that was going down, and I was walking down the aisle taking applications, and I asked you, how much life insurance would you like? You would say, as much as I can get, right? How much, right? But that's not how it works. But that is honestly a true fact, right? That we know that it is the cost that tends to put us off. So, solving for the human life concept answers this question. And, how much coverage should you have? It changes it from that to how much do you want? And this is why, again, dealing with a professional, looking at your different types of life insurance and how it can be integrated into all your plans. Insuring yourself up to human life value gives you as much, keyword here, certainty. So your money in your 401k, not guaranteed to be there. Plus there's taxes that you got to pay on it. Money you got in your savings account, brokerage account, it's not necessarily going to be there. How much of it's actually going to go and how long will last? When you think about it purely, if I took the name life insurance and I just called it, say, a screwdriver, or I called it a hammer, or I called it a saw, it is a tool. And if properly structured, it can help families to avoid or to get through a tragedy at a time that is absolutely devastating for most families. And so, I'm thinking of an advisor that used to work with us, and this gentleman was 44 years old. I shared that he, 2 years ago, he passed away. Actually, last year, early in the year. And when he passed, I found out after the fact, at 44 years old, he's in my business, but because he came under hard times, he had let his life insurance lapse. He had a big house, had 2 young kids, had a wife that stay at home. And it just because it got down into what could he afford, and he let it lapse, and it's a big mistake. So, we got to really make sure that we don't want to have a life preserver that's too big that we drown or choke on it. However, one of the things I do know is that you cannot buy as much life insurance as you think that you can. That's where human life value comes in. Generally, the rule of thumb for value, calculating human life value is about 15 to 30 times or insuring up to your net worth. So it's 15 to 30 times your income or up to your net worth. This multiple isn't random. This is done by actuaries. It's actually represents current income multiplied by the number of years the insured is expected to earn in income. In other words, the income your client has left to earn until their typical retirement. So, I took the words and I applied some math. Right. So let's just say you're 40. Now, there's people on this call that are 50, 60, maybe even 70. And if I had a nickel every time, well, I'm too old, I should have done this years ago. Right. It's not. If you turn around, this doesn't have to be one solution, one size fit all, but a combination of solutions should be considered. But let's say in this example, this person was earning $100,000. And they were expected to work for another 25 to 30 years, right? So 25 puts them to 65, 30 puts them to 70. So if I take that 100 grand, that means that they should be looking at $2.5 to $3 million of a coverage. But if you were to buy 25 to 30 year term purely from an expense standpoint to replace your income, most people will look at this and go, and they choke. including myself, right? The numbers you start looking at, because it's purely from an expense standpoint. And when you look at it from that needs base, those other factors, you got kids' education, you got the retirement. Because remember, as soon as you retire at 65 to 70, now you still got roughly 25 to 30 years left on the planet to be able to get through retirement, depending on how much money you saved in your 401k or IRA. And this is why I take such issue with that whole concept, buy term and buy the difference. Because what that assumes is that when you get to retirement, you will not need any insurance. And again, that means that your investments performed, taxes were not taken out yet, and that you turn around and were able to make it through and live frugally. I just have found that has never been the case, yet people will swear by it because it sounds affordable. Your mortgage, okay, we got to retirement, that's all I needed for, just in the event that I pass away, that the mortgage is paid off. And again, that is a consideration and a factor that's not even taken into the calculation above, other than that if maybe part of that $100,000 from that person that was contributing to the household income was going towards paying for the mortgage. And if that's the case, then that number does make sense. But remember, insurers do have a ceiling on how much they're going to give you. If this same person went to them and said, hey, I want $10 million of insurance, when's the only time somebody approaching an insurance company and saying, I want more than you could possibly give me? And that's when they already know that they're ill, probably terminally ill, and that they don't have long left on this planet. Childcare, right? Like I mentioned before, and then net worth, right? So those are some of the factors that go into it. So when I was talking about a combination of strategies, right, we have group term at work. It's the cheapest type of insurance you will get. If this person had $100,000 at work, pennies on the dollars, he could get $500,000 up to 5 times, typically, depending on the employer and the type of plan they have, 1 to 2 to 3 to 4 to 5. And it's the cheapest term insurance. But here's what happens: as soon as you retire, you do not own it. And it may be convertible, but to whatever product that company has on the shelf. And typically that amount of coverage at that age in your life, you will now be rated for, say, a 65-year-old male. And at that point in time, you could find that the premiums, again, unaffordable. So what do most people do? They drop the death benefit and they end up being underinsured. Term is renting, right? You got to remember that, right? Yeah, listen, I rented when I was younger. I understand that we're taking money and throwing it out the window. There's nothing wrong with it. I had a roof over my head. It allowed me to get to where I am today. But I figured out along the way why permanent home ownership made sense. Now, what type of permanent insurance? Depends, right? Whole life is permanent, right? It's got its place. Some people prefer that. I'm not here to get into the weeds on that. Variable insurance, I used to offer that. I'm not a fan because it's subject to market risk. Universal life, it's another type of plan. I think it takes a little bit of the risk from the market off the table, but now it integrates the insurance companies, because what they tend to do is change some of the rules along the way. I am a big fan of index universal life, and that is because we can design plans that'll help supplement income into retirement and also will transition into an income tax-free death benefit. So these are some of my experiences. I just wanted to share with you, Human Life Value. It is Life Insurance Awareness Month. And again, if you do nothing else, pull out your contracts, whether they be life, whether they be annuity, whether they be long-term care, pull out your 401k statements, pull out your IRA statements, anything that has a beneficiary. And I want you to go in there and double check your beneficiaries. Things happen, right? People die, we age out, right? Depending on when we took those policies out, or maybe we get divorced, things don't work out. So it is a good habit to review. Make sure that what you want to happen, because if you left those beneficiaries blank, or maybe you put in there a primary, and now you turned around and that person that you named as a primary deceased, and now all of a sudden it's now you pass, now it goes to the estate. right? And now the estate gets to divide that out. So you just got to be aware that things change as we get older, and that quite often human nature is we take that and we put it into a drawer and we don't look at it again. If you want to review what you got, happy to do so. They are complex vehicles, but they're just tools. And if we go into it with an open mind, saying, "Hey, what can or should I be doing to help achieve financial freedom faster?" we can help with professional planning services. So, folks, great seeing everybody. Obviously, I'm back from vacation. I had a great time, and again, if you need me, please reach out.